Hello, hello. Hi, everyone. Welcome back to the Mortgage Q podcast. Hope you guys are doing well. This week has been going great, I feel. Now let's get to the real talk. I think we're all feeling the pressure. The purchase market is here. Refinance deals are drying up, and only loan originators who are still winning are the ones who adapted by diversifying. Non-QM is one of those lanes, but is it really stable or just another patch until the next cycle? Let's unpack that today.
Yes, hey guys, this is the episode 5 of the Mortgage Q podcast.
I am your host, Jason.
And it's me, your co-host, Sarah. And today we are discussing,
are non-QM loans a stable option for loan originators? Let's discuss if they are stable in 2025 and beyond.
Yeah, it's a concern of many loan officers.
I know we are here to address that concern. You know, our sources say that. The pandemic shifted the workforce. Nearly half the private workforce is now small business owners, contractors, or gig workers. They make a lot of money, but not in a way that fits conforming or government loan boxes.
Exactly. Think about the dentists, landscapers, and the Uber drivers. They have got solid income, but tax returns that disappear the cash flow. For them, non-QM is not a luxury. It is the only way in for a mortgage. Jason, I think we should break down the main benefits about the non-QMs for our listeners.
Yeah, let's do it. First off, the underwriting in non-QM loan is just more flexible. You are not boxed into one rigid formula.
Exactly. And on the income side, you have got more ways to verify it. You can use bank statements, asset depletion, alternative documents. It is not just W-2s and tax returns.
Yeah, in fact, sometimes there's no employment history requirement at all. If it's asset utilization or depletion, the file can still work.
And their entry point isn't crazy either. The down payments can start around as low as 10%.
Plus, in non-QMs, reserve requirements can be lighter on certain programs, which really helps borrowers who have cash flow but not deep savings.
And the credit scene is more forgiving too. The credit scores can go down to 620, sometimes even 580 if they've got compensating factors.
And let's not forget the investor side. DSCR loans are huge right now. The committee will even let you use rental income, including Airbnb or VRBO, to make the deal work.
All in all, these aren't niche products. They're real tools that let you capture borrowers who'd otherwise be locked out.
Yep. So here's the translation for any loan originator listening. Non-QM isn't a one-size-fits-all box. It's more like different lanes on the highway. You can actually place borrowers where they belong instead of forcing them through agency guidelines that don't fit. And what does that mean for you? You get more closings, happier realtors, and steadier commissions.
Right. But Jason, here's the catch. A lot of borrowers and even some brokers still think non-QM is sketchy. They are skeptical about it.
I know, Sarah, and this is why education matters. You don't sell non-QM as a loophole. You frame it as a different evaluation method. You explain it as a different way of evaluating the borrower's ability to repay. The borrowers still have to prove that they can make the payment, but it's just measured differently.
And when you frame it that way, people start to realize it's not a weird product. It's just another loan option that makes sense for people with certain profiles. All right, I have another point to make. Let's be real. When COVID hit, non-QM just froze. A lot of liquidity dried up, the big aggregators disappeared, and most originators ran straight back to doing agency loans.
Yeah, it was like someone pulled the plug. But by late 2021, the lights came back on. We saw it. The securitizations restarted, investors returned, and suddenly non-QM volume started ramping again. Many articles even pointed out and valued it around $25 billion in originations for 2021, with analysts thinking the market could actually double in 2022. Let's also look at 2025. We already non-QM is no longer fringe. And in July 2025, non-QM loans reached 8% of total rate lock volume. It reached a record high. Scotsman Guide also reports that non-QM accounted for around 5% of originations in recent years, and now S&P Global expects non-QM to make up nearly 30% of non-agency mortgage-backed securities.
This sounds very promising, not gonna lie. But let's be honest, Jason, this is not a free-for-all. Non-QM only works if you respect and stick to some ground rules. You have to set expectations early. Talk to the borrower about the rates, the reserves, the prepay penalties, and the timelines. Make sure the borrower knows what lane they are in.
Yeah, and always explain to them the trade-offs. Flexibility usually comes with a higher rate. That's not a surprise if you tell them up front.
Exactly. And don't let sloppy files sneak through. Get clean documents at the start. Don't wait until the end to find surprises.
And always remember, the overlays aren't universal. Just because one investor allows something doesn't mean they all do. One matrix doesn't equal the market.
And I think this is why having your process tight and non-QM matters.
And here's where technologies can actually make your life easier. AI tools like Mortgage Q help you get ahead. But also remember, at the end of the day, you sign your name on that file, so the responsibility is still yours. And if you only remember 3 things, make it these. You either diversify or starve, because non-QM opens up you to a wide range of borrowers that agency never will. Remember that education is half the battle for your clients and your referral partners. And always plan for cycles, because non-QM might pause in tough markets. But the data looks promising, though. If someone would ask me, are non-QM loans a stable option for loan originators? From my experience and the trends, I would say, yes, it's stable.
Yep, I think it's more than stable enough to get into right now. If you are someone who wants to prepare for a non-QM or get into one, don't forget to try out Mortgage Q. It is an AI software for loan officers that takes care of the boring prep so you can sound sharp when it counts.
Okay, guys.
This is all for today's episode. This podcast is educational, not legal or compliance advice. Thanks for listening. We'll be back next week with yet another episode.
This podcast is by Mortgage Q, a platform where AI assists and you decide. See you next week.
Bye, guys.